Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Yeah, we have a really wild one on the desk today.
We really do. Today, we're breaking down one of the most interesting companies on the market, the biotech anomaly, Savara Inc., ticker symbol SVRA.
It is definitely an anomaly.
On the surface, the market is pricing this company as a near certain winner with a potential billion-dollar drug. But the deep dive question for us as long-term investors is this. Are investors paying a premium for a binary coin flip? Is this a compounding engine or just a speculative engine disguised as an investment? The promise today is to uncover if there are hidden cracks in the fortress that the market is ignoring, specifically looking at the dangerous lack of a margin of safety.
That's a huge topic. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now, let's get into it. Pillar number 1, the business model.
Okay, so let's unpack this. We are looking at a company, Savara, that is currently valued at over $1.1 billion.
Which is a massive number.
It is a massive number. That is unicorn status in the public markets. But here is the kicker, and this is where it gets really interesting and, frankly, a little scary. They have absolutely zero revenue.
Nothing.
Not a dime coming in the door.
Which, is not uncommon in the biotech sector, but it absolutely sets the stage for a very specific type of analysis.
Right.
When you look at Savara, we are looking at what we call a black box model. This is a pre-revenue clinical stage biopharmaceutical company. So the core economic transaction, the actual thing that brings cash in the door, it does not currently exist.
It's entirely theoretical.
Entirely. So we aren't analyzing sales growth, we aren't analyzing operating margins, and we aren't analyzing customer retention yet because, well, there aren't any customers.
We are analyzing a promise.
Exactly. A narrative. You aren't buying a business today. You are buying a probability. You are buying a ticket to a future cash flow stream that might literally never happen. And that entire promise hangs on one specific product.
Molbreevi.
Yeah, Molbreevi.
It sounds like a fine Italian wine, but it's definitely not.
Far from it. Molbreevi is a molgramostim nebulizer solution.
Try saying that 3 times fast.
I won't. But getting past that tongue twister name, to really understand the business case here, you have to understand the target. They are targeting a disease called autoimmune pulmonary alveolar proteinosis.
Or APP for short.
Right, APP.
And for those of us who didn't go to med school, and I'm assuming that's most of you listening, what exactly is APP? Because to understand the value of this company, we have to understand the pain they are trying to solve.
Right, precisely. The why is crucial here. So ideally, your lungs are filled with these tiny air sacs called alveoli. These sacs are the mechanism that actually lets oxygen get into your bloodstream. They need to be clear. They need to be elastic. In APP patients, the body's immune system mistakenly attacks the proteins that keep those sacs clean.
So it's an autoimmune disorder where your body is basically sabotaging your own lungs.
Correct. The result is that these air sacs get clogged up with a buildup of protein and other surfactant materials. Think of it like a thick sludge.
Yeah.
Yeah, it essentially suffocates the healthy lung tissue. It's a chronic, incredibly debilitating condition. Patients end up chronically short of breath, constantly coughing, completely unable to exercise, and they are highly prone to severe respiratory infections.
That sounds absolutely nightmarish.
It is.
So the economic transaction here isn't selling a sauce product or a consumer widget. It's selling a lifeline. But what are they doing for these patients right now? Like if I have AP today, what happens to me?
This is the key for the investment thesis. The current standard of care is just brutal. It's a procedure called whole lung lavage.
Lavage. That usually means washing, right? Like in French.
Yes, washing. They essentially put you under general anesthesia, they intubate you, isolate one lung, and physically wash it out with liters and liters of saline solution.
You're kidding.
No, they literally power wash your lungs from the inside to get that sludge out.
Oh, they fill your lungs with water while you're unconscious?
Yes. It's highly invasive, it requires a specialized hospital stay, it carries all the standard risks of deep anesthesia, and worst of all, it's not a permanent fix.
Because it's an autoimmune issue.
Exactly. The sludge just comes back. You have to keep going back to the hospital to do it again and again.
Okay, I see the value proposition now. Savara comes along and says, hey, instead of going to the intensive care unit to have your lungs power washed while you're in a medically induced coma, just inhale this mist.
That's the pitch. Molbrivi is an inhaled therapy. You just take it at home. It chemically stimulates the cleaning cells in the lungs, the macrophages, to wake up and naturally eat that protein sludge.
Wow.
It's a complete paradigm shift for the patient.
So if this actually works, the business model transforms. It goes from a highly transactional, surgery-based model controlled by hospitals to something that looks a lot more like a high-stakes subscription model controlled by Savara.
That is the crucial distinction you have to make as an investor. If Molbrivi gets approved by the FDA, they aren't selling a surgical gadget. They are selling a chronic, recurring therapeutic regimen.
A daily or weekly dependency.
Exactly. And who is actually paying for it? It's almost never the patient paying out of pocket. It is commercial and government health insurers.
And this brings us to the concept of pricing power. In traditional businesses, we always look for companies that can raise prices without losing their customers. How does that apply here when Savara hasn't sold a single unit yet?
Well, it's theoretical right now, but it's incredibly powerful. This is the underlying economics of orphan drugs.
Right.
Because APAP is a rare disease, the total addressable patient market is quite small. But to incentivize pharmaceutical companies to spend hundreds of millions developing drugs for small markets, the regulatory system essentially allows for sky-high pricing.
So if Savara gets approval, they theoretically have immense pricing power.
Immense. This is the economic concept of demand inelasticity.
Explain that for the listeners. Demand inelasticity.
Sure. Think about a consumer product like Netflix. If Netflix doubles its subscription price to $50 a month tomorrow, a massive number of people will cancel.
I definitely would.
Right. The demand is elastic. It stretches and shrinks based directly on the price. But if you have a life-threatening, suffocating condition, and there is only one drug on the shelf in the entire world that fixes it,
you pay whatever's on the price tag.
Exactly. Or rather, you fight your insurance company tooth and nail to make them pay it.
Because you don't shop around for life support.
No, you don't. There are no generic alternatives to switch to. So the potential economic engine here is extremely robust. Very high price, recurring revenue, incredibly sticky customers.
If the key turns, the engine actually starts.
If. That is the $1,000,000, or I guess the $1,000,000,000 word.
Which leads us perfectly into our moat assessment. We constantly look for companies with an economic moat, something protecting their profits from competition. Does Savara actually have a moat?
They have the potential for what we call a cornered resource moat. In this specific framework, the resource isn't a diamond mine or a prime piece of real estate. It's intellectual property and regulatory capture.
Regulatory capture. That always sounds a bit nefarious to me.
It sounds worse than it is. In this context, it just means that the government, via the FDA, legally grants them market exclusivity.
Okay.
Through the orphan drug designation and their specific patents, competitors are legally barred from accessing the resource, the APP patient pool. If Molbrivi is approved, the government essentially hands Savara a state-sponsored monopoly for a set period.
Usually 7 years for orphan drugs in the U.S., right?
Yes, 7 years. That is a very, very strong moat on paper.
But I'm sensing a massive but coming here. You mentioned in the hook that we need to look for cracks in the fortress.
The but is that this is an incredibly fragile moat. It's what we actually call the anti-moat rebuttal.
The anti-moat.
Yeah. Think about a traditional moat, like a powerful brand think Apple or a network effect think Facebook or Visa. Those moats degrade very slowly. It takes years, sometimes decades, to lose that competitive advantage.
Right. People don't just wake up and stop using Visa all at once.
Exactly. But Savara's moat is completely binary. It relies entirely on the FDA's signature. If the FDA issues a rejection, the moat doesn't degrade slowly. It evaporates instantly.
It's like having a castle with 50-foot thick walls, but the entire foundation is made of glass. One well-placed rock throws the whole thing down.
That's a perfect analogy. And there's another existential risk to this moat: technological obsolescence.
Let's talk about that.
We are currently seeing rapid advancements in gene therapies across the biotech space. Right now, Molbrivi treats the symptoms. It clears the protein sludge out of the lungs. But apopy is ultimately caused by a biological signaling error in the patient's DNA.
So what if a company develops a gene therapy that permanently fixes that pathway?
Then Molbrivi becomes obsolete overnight. It's like being a company that makes the absolute best DVD player on the market right when streaming video is invented.
It doesn't matter how good your DVD player is. The fundamental problem of watching movies is just solved a completely different way.
Exactly. So while Savara's moat looks legally impenetrable right now, structurally it is highly susceptible to both a sudden regulatory rejection and long-term technological disruption. It's simply not a fortress you can sleep easy in.
I want to shift gears to a mental model that I know you love applying to these types of high-risk companies. George Soros's theory of reflexivity.
Oh, yes. This is absolutely critical for understanding clinical stage biotechs like Savara. If you, as an investor, don't deeply understand reflexivity, you really shouldn't be putting your money into pre-revenue companies.
So normally, the traditional way we think about the stock market is that the stock price follows the underlying business performance.
Right.
If the actual business does well, if it sells more widgets, makes more profit, then eventually the stock price goes up to reflect that reality. Reflexivity says it can actually work the other way around, right?
Correct. Soros argues that in certain specific situations, the stock price itself actually influences the fundamental reality of the business.
Give us an example of a normal company first.
Think about a mature cash cow, like Coca-Cola. If Coca-Cola's stock price drops 50% tomorrow due to some market panic, does the underlying company stop selling Coke?
No.
Does the syrup stop flowing in the factories? Do the delivery trucks stop running?
No. They still have massive cash reserves. They still have their bottling plants. They still have millions of customers blindly buying the drink every single day.
Right. For Coca-Cola, the stock price is just a passive scorecard. The business operates completely independently of Wall Street's daily mood swings.
But Savara is fundamentally different.
Savara is completely different because of a concept called capital dependence. Remember, they are constantly burning cash, so they have zero revenue. To keep the lights on, to pay their scientists, and to run these incredibly expensive clinical trials, they have to constantly raise new money.
And how do they usually do that?
Usually by issuing new shares, selling fresh equity to the public markets.
So they inherently need a high stock price so they can use their own stock as a strong currency.
Exactly. Their stock literally is their money. If the stock price is high, let's say it's $10 a share, they can easily raise $100 million by selling 10 million new shares. Existing shareholders get diluted a little bit, but the company easily survives and fully funds the next phase of the trial.
But, and here is where the danger really lies, if the stock price collapses.
Yeah.
Let's say due to a bad rumor on a message board, or a minor delay in trial enrollment, or just a broader macroeconomic market crash.
The cost of their capital skyrockets.
Explain the math on that.
If the stock drops from $10 down to $2 to raise that exact same $100 million they need to survive, they now have to sell 50 million new shares instead of 10 million.
Which causes catastrophic dilution for anyone currently holding the stock. You suddenly own a much, much smaller piece of the total pie.
Or worse, market sentiment sours so much that nobody wants to buy the new stock at all, and they simply can't raise the money to finish the trial.
A total freeze-out.
This can trigger what we call a death spiral. A low stock price causes a real-world cash crunch, which then causes the stock to drop even further because institutional investors smell the fear, which makes raising cash even harder, and down it goes until the company goes bankrupt.
So unlike Coca-Cola, Savara's actual physical survival is reflexive to its stock price. The Wall Street narrative actually drives the corporate reality.
Precisely. If the market suddenly stops believing in the Mulbrevy narrative, the company can actually die purely because the belief evaporated. That is a terrifying dynamic if you're the one holding the bag. It puts a tremendous amount of pressure on the soft power of the company, the corporate culture, and how meticulously the management team spins their narrative to Wall Street.
It really does. And when we look at the inside view of Savara, their actual corporate culture, it isn't indexed toward aggressive sales efficiency yet.
No, not at all.
It is heavily indexed toward regulatory execution. They are focused on hitting PDUFA dates, managing complex clinical trial data, and talking to the FDA. Their main relationships right now are with patient advocacy groups.
Which act as a sort of pseudo-brand moat in the rare disease space.
Right. But the internal machinery of the company is built entirely for clinical approval, not yet for commercial profit.
Which is arguably appropriate for the stage they are at right now, but it means they are entirely dependent on external capital markets to build the bridge to get to that future profit.
So we have a binary, fragile moat and a business model that is reflexively dependent on the stock market's mood just to keep the lights on. Let's move to the hard numbers to see what this bridge actually looks like. Pillar number 2, financial resilience and capital allocation.
This is where we typically apply the quality of earnings test to a company. Or in this specific case, since there are literally zero earnings, the quality of burn test.
I like that. Quality of burn. We are looking at a current cash burn rate of approximately $99 million in free cash flow annually.
That is a staggering amount of money.
They're incinerating nearly $100 million a year just to exist as a corporate entity and run these clinical trials.
And as analysts, we have to look really closely at where that money is coming from and exactly where it's going. A major red flag here, and this is something retail investors almost always miss, is the SBC, or stock-based compensation.
Let's dig into that.
It's currently sitting around $12.1 million for the year.
That sounds like a lot for a company with absolutely no product and no revenue. That's over $1 million a month in free stock just being handed out to executives and employees.
It is a lot. Think about the underlying math here. The total operating cash outflow is about $99 million. The SBC is $12.1 million. That means stock-based comp makes up roughly 12% of their total operating cash burn.
Why is that such a red flag, though? I mean, shouldn't key employees and scientists have skin in the game? Don't we want them aligned with the stock?
They absolutely should have skin in the game, but for you, the outside shareholder, it represents a massive quality of earnings failure.
How so?
Because operating cash flow is deeply negative, their free cash flow conversion metric is technically completely negative.
Right.
But more importantly, look at the hidden dilution cost. Outside shareholders are getting hit from two different sides simultaneously.
The double dilution effect.
Exactly. First, you are being slowly diluted internally by the executives and employees, getting that $12.1 million in newly printed stock every year. The total share count creeps up. Second, you are being heavily diluted externally by the massive secondary equity offerings, like the recent $80 million capital raise they just did, that the company is forced to do just to pay the actual bills. The ownership pie is getting cut into smaller and smaller slices from both ends.
It feels like running on a treadmill that's slowly speeding up. You have to keep issuing more and more shares just to stay in the exact same place financially.
And that terrible dynamic reflects directly in the ROIC, the return on invested capital. For Savara right now, ROIC is deeply, deeply negative. It completely fails to exceed their weighted average cost of capital, or WACC.
Let's remind the audience what we look for there.
An elite compounding business generates a positive spread. It makes significantly more profit on its money than it costs the company to borrow or raise that money.
A spread of maybe 10 or 15%.
Right. Savara is currently destroying capital at a massive rate just to try and prove a scientific thesis.
To be fair to management, that is just the fundamental nature of the beast in the biotech industry. You burn immense amounts of cash until you boom. You have to build the entire billion-dollar factory before you can sell a single car.
That is very true. But as objective analysts, we have to score it honestly based on the current reality. It is not a financially efficient business today. It is a cash incinerator.
But we should give credit where it is due regarding their capital allocation strategy.
You mean the report card for the management team? How are they actually behaving with the scarce money they do have?
Yes.
Well, they are passing the focus test. Management is currently putting 100% of their usable capital directly into organic growth, specifically the R&D for Molbreevi. In our capital allocation value hierarchy, that is the highest tier possible, provided the R&D actually works.
They obviously aren't doing share buybacks.
No, which makes perfect sense. They have no excess cash to buy back shares, so the cannibal factor is completely absent here. But crucially, they are aggressively avoiding diversification.
Diversification. That's a classic Peter Lynch term, right?
It is. It refers to management teams buying unrelated businesses they don't understand just to build a bigger empire or pad their top-line revenue.
Right, like when a struggling biotech management team suddenly gets nervous about their clinical trials, so they go out and buy a random commercial skincare company or a small medical device firm just to show Wall Street some immediate revenue and save their own jobs.
Exactly. We see it all the time, and it almost always destroys shareholder value. But Savara's management isn't doing that. They are incredibly disciplined. They are focused entirely 100% on getting Molbreevi across the FDA finish line.
So they are completely all in.
They are burning the furniture to stay warm, but at least they aren't going out and buying more expensive furniture they don't need. They are betting the entire farm on the one horse they truly believe in.
So highly disciplined, but inherently desperate. Or maybe singular focus is the polite way to say it in a boardroom. But the overarching financial resilience is very low.
Yeah.
They absolutely need that SDA approval. They cannot afford any kind of delay.
No, they can't. A one-year regulatory delay would likely require them to execute another $100 million capital raise just to survive the waiting period, which would dilute the existing stock massively. They are walking a very thin tightrope right now.
Which brings us to the future. Pillar number 3, growth, valuation, and fair value. This is the crucial part where we try to mathematically figure out what this speculative engine is actually worth today. Because right now, the stock price is sitting around $5.50. Is it actually worth $50 or is it worth zero?
Well, the growth engine is very simple to define. It's the catalyst. All future cash flows for Savara depend entirely on the FDA approval of the biologics license application for Molbreevi.
And that application is currently under priority review.
It is.
Priority review is inherently a good thing, right?
Yeah.
It means the FDA thinks the drug is important enough to skip the standard line.
It creates a significantly faster regulatory timeline. Yes, it de-risks the long schedule. But investors need to remember it does not guarantee approval in any way. The FDA can still turn around and say, hey, we really like the mechanism of action, but your third-party manufacturing plant isn't up to our strict quality codes.
Or they could say the phase 3 data isn't statistically significant enough in a specific subgroup.
Exactly. Now, to justify the valuation, management is publicly claiming a total addressable market, a TAM of over $1 billion in the U.S. alone. That is the big, shiny number sitting on page 3 of their investor presentation.
And here's where I have to play the skeptic for the audience. I always get nervous when pre-revenue companies just casually throw around the phrase billion-dollar TAM.
I knew you would. And you should be nervous. Break it down for us. Why shouldn't we blindly trust the management's $1 billion number?
Well, we have to view that top-down number with extreme caution. The actual clinical prevalence of APEP is tiny. It's an ultra-rare disease. To actually hit a $1 billion annualized run rate, Savara would need absolute perfect market penetration.
Which never happens.
Never. They would literally need to find every single patient in the country, even the ones who are currently misdiagnosed or haven't been diagnosed yet. They would need to convince every single doctor to prescribe it, get every patient to consistently take the drug, and they would need to maintain incredibly aggressive orphan drug pricing for years without any pushback from the insurance companies.
That sounds like the ultimate blue sky scenario. Everything has to go perfectly right from day one.
Exactly. It completely assumes zero friction in the real world. But real commercial life has immense friction. Patients get side effects and refuse treatment. Older doctors stubbornly prefer the old lung lavage method they trained on. Insurance companies aggressively deny initial claims to save money. To value the company today based on perfect future execution is incredibly dangerous.
So let's look at what the broader market is currently betting. We have a market cap of roughly $1.14 billion today. What fundamental reality is heavily implied by that current price?
We use a mental model called a reverse DCF, a reverse discounted cash flow, to figure this out.
Right.
Instead of trying to guess the future stock price, we take the current price of $1.14 billion and work backward. We ask, what set of future facts mathematically creates this current price?
And what did the model tell you?
Well, assuming a standard mature biotech valuation multiple of roughly 3 to 4 times peak sales, the market is currently expecting Savara to smoothly reach somewhere between $300 million and $400 million in recurring annual revenue by the year 2030.
300 to 400 million. That is essentially a third of their claimed billion-dollar TAM. On the surface, that sounds somewhat achievable, doesn't it? If the TAM is really $1 billion, catching 30% market share over 6 years seems reasonable.
It might be reasonable in a vacuum, but here's the massive catch. The market is pricing that $300 million in revenue as a near certainty today. The current $1.1 billion valuation essentially assumes FDA approval is already a done deal and that the initial commercial launch goes reasonably well without any major hiccups.
So there is absolutely no oops factor priced into the stock.
None.
If they successfully get approved by the FDA, but they struggle with the rollout and only sell $100 million in the first few years, the stock goes down heavily from here.
Precisely. If they get an outright FDA rejection, the stock goes to near zero instantly. If they get approved but struggle to actually sell the boxes, the stock goes down. The current price of $550 is heavily priced for absolute perfection.
Let's try to triangulate the fair value to see if we can find a margin of safety anywhere.
Okay, let's do it. If we look at our standard intrinsic value triangulation method, we see a massive disconnect across the board.
Walk us through the methods.
Method A, which is historical mean reversion, is completely useless here because they have no financial history of selling anything. Method which is Wall Street analyst consensus, is incredibly bullish right now. The street has an average price target of roughly $11 a share.
Wow, $11. That is exactly double the current market price of around $5.50. Wall Street is basically screaming, buy, buy, buy.
They are. But remember, sell-side analysts are very often selling that exact blue sky scenario we just talked about, and they notoriously often update their price targets only after the stock has already moved.
They are following the momentum, not leading it.
Exactly. So let's look at Method C, simplified owner earnings.
Yeah.
Let's do some very basic napkin math to ground ourselves.
Got my mental calculator ready. Go ahead.
If we generously assume Savara hits the optimistic Wall Street 2028 EPS estimate, so we are looking a full 4 years into the future here, the estimate is 14 cents per share. That's the actual net profit per share they expect in 2028.
14 cents. Okay.
And then we apply a very generous 20x price to earnings multiple to that future profit, which is a very standard, healthy growth multiple for a mature company.
Let me do the math. 14 cents times a 20 multiple, that's $2.80.
$2.80 per share of intrinsic value.
And the stock is currently trading at
$5.50.
That is a massive, glaring disconnect. The owner earnings model, even when we are using optimistic profit numbers from 4 years in the future, mathematically suggests it is drastically overvalued today. The stock is currently trading at double what the fundamental math says it should be worth in a steady state.
And that is exactly why we have the synaptic fair value estimate. Based on our risk-adjusted models, our strict buy zone for Savara is between $3.50 and $4.50.
So at the current price of $5.50.
At $5.50, there is zero margin of safety. None. You, as an investor, are paying a massive premium for a binary coin flip. A true margin of safety requires you to buy the asset at a steep discount to its risk-adjusted commercial prospects, actively accounting for the high base rate of failure in biotech. Right now, the $5.50 price reflects pure, unadulterated optimism, not analytical safety.
That is a very sobering reality check. You are essentially paying full retail price for a scratch-off lottery ticket that hasn't even been scratched yet. You are paying for the Super Bowl win before the very first game of the season is even played.
That is exactly how I see it. It's a fundamental mispricing of risk.
Well, if we want to be truly safe investors, we have to look closely at the worst-case scenario. Pillar number 4. Risks and the premortem.
I love the premortem framework. We basically invert the problem. We assume it is the year 2030, we look at our portfolio, and we have lost 100% of our money in Savara. We ask ourselves, how did it happen?
Kill criteria number 1 seems fairly obvious to anyone watching the space. Regulatory rejection.
Yes. The FDA issues a complete response letter, or a CRL. This is the absolute death knell for a clinical stage biotech.
What usually triggers a CRL?
They could cite complex manufacturing issues, which happen surprisingly often in biotech, where the actual drug science works perfectly, but the third-party factory is deemed dirty or out of compliance. Or they could cite primary efficacy concerns in the trial data. If that CRL drops, the stock doesn't just experience a mild dip.
No, it loses 70 to 80% of its total market value in a single pre-market trading session.
Because the entire fundamental premise of the company evaporates instantly. The black box is suddenly opened and shown to be completely empty.
Correct. The Soros reflexivity we talked about aggressively kicks in, the capital markets completely dry up overnight, and they're likely forced to dissolve the company or sell the corporate shell for pennies on the dollar.
But there's a much more nuanced risk here, isn't there? Kill criteria number 2. This is the one that I think traps a massive amount of retail investors who falsely think FDA approval automatically equals immediate profit.
Commercial failure. This is the silent killer of the biotech industry.
Walk us through it.
Let's say they successfully get the FDA approval. The champagne pops in the boardroom. The stock spikes 20% on day 1. Everyone is celebrating. But then the hard reality sets in. They actually have to sell the drug.
And as a company, they have never sold a single thing before.
Exactly. They have absolutely zero commercial infrastructure in place today. They have to build a highly specialized national sales force completely from scratch.
Which is incredibly expensive.
It's astronomically expensive. They have to hire experienced pharma reps to physically cover the entire United States. They have to sit down and negotiate brutal reimbursement contracts with massive payers like Blue Cross and Medicare, who might aggressively push back on the high orphan drug price and say, hey, We need 3 more years of real-world data before we agree to pay $100,000 a year for this mist.
And they have to educate the actual pulmonologists.
Right. They have to spend millions educating doctors who have never heard of Molbreevi and are currently very comfortable just prescribing the old lung lavage hospital method.
This is the classic red team challenge. It's pure survivorship bias. As retail investors, we only ever hear about the blockbuster drugs that launch and make billions of dollars. We literally never hear about the hundreds of drugs that get approved, launch, and completely flop in the market.
The outside view is just brutal here. The historical base rate of value destruction for biotechs trying to transition from a clinical research outfit to a commercial sales organization is surprisingly high. Launching a new drug from scratch is arguably much harder than running a controlled clinical trial.
Because in a trial, you completely control the environment and the patients. In the open free market, you control absolutely nothing.
Nothing. And the operational costs.
The SG&A, cost selling, general, and administrative expenses, they just explode. You have to hire armies of sales reps, sophisticated marketing teams, complex cold chain distribution logistics. These upfront costs literally incinerate cash.
And the tragic irony is that this massive cash burn happens right at the exact moment when retail investors are finally expecting to see bottom-line profits.
So you get your coveted FDA approval, your internal operating costs suddenly triple, your initial revenue only trickles in very slowly because the physician launch is hard, and suddenly you are burning even more money than you were during the phase 3 trials.
Which logically leads to, you guessed it, even more dilution.
The dreaded secondary offering right after approval.
Exactly. It's what industry insiders call the commercial valley of death. Naive investors think the financial risk completely ends the second the FDA grants approval. In reality, often, that is exactly when the true financial risk actually begins.
So kill criteria number 2 is that even with a successful approval, they missed their first few quarters of revenue estimates, the reflexive Wall Street premium completely collapses, and the stock tanks anyway because the hypergrowth story is broken.
That is a very tough pill to swallow for the bulls. So taking all of this complex analysis into account, the fragile binary moat, the deeply negative current financials, the massive valuation disconnect we found in the owner earnings, and the looming commercial execution risk, what is the final verdict?
The Synaptic scorecard is very clear on this one. First, the quality score, low so. Without an ROIC consistently greater than 15% or a positive free cash flow conversion rate, it is an automatic reject for our core long-term compounding portfolio. We simply cannot objectively call this a high-quality business yet.
And the valuation score?
Expensive. The current $1.14 billion valuation leaves very little room for operational error. It is heavily priced for perfection.
So structurally, how do we classify this asset?
This is strictly a speculative engine. It is not a compounding engine.
That is a vital distinction for portfolio management. A compounding engine is a highly durable, cash-producing asset you hold for a decade while it steadily grows your wealth, like a Costco or a Microsoft. A speculative engine is just a calculated bet on a future binary event.
Exactly. You casually date a speculative engine, you marry a compounding engine. You definitely do not marry Savara. Not yet, anyway.
Now, let's quickly summarize the thesis for total fairness to both sides, because there is a legitimate bull case here. Otherwise, institutional money wouldn't have the stock at $5.50.
Absolutely. The bull case is straightforward. The FDA priority review significantly de-risks the time to market. The orphan drug designation provides a very strong legal moat for 7 years. The management team is laser-focused and wisely avoiding value-destroying M&A. And fundamentally, if the drug works and they can successfully penetrate the market, the gross margins on an orphan-inhaled biologic will be absolutely astronomical.
So if it hits very big. In a perfect scenario, it could easily be a $20 stock.
It could, but the bear case is just as heavy. It is an extreme binary risk. They are highly capital dependent and constantly facing potential dilution death spirals. They have zero historical commercial track record of selling anything. And most importantly, based on our math, you are simply paying way too much for the lottery ticket today.
So looking forward, say 5 to 10 years out, what is the ultimate destiny of Savara?
It's what we call the acquisition thesis. Honestly, looking at the structural challenges, the absolute best financial outcome for Savara shareholders is not remaining an independent company. It is being acquired outright.
By a massive big pharma giant.
Yes. Imagine a behemoth like Pfizer or GSK coming in. They already have the massive global sales force built out. They already intimately know every single respiratory doctor and pulmonologist in the country. They already have the complex shipping contracts and the insurance payer leverage.
They can just take Molbrivi, plug it directly into their existing sales bag, and start selling it profitably tomorrow morning with almost zero extra overhead costs.
That makes so much strategic sense. Why would Savara spend $500 million to build a national sales force when they can just rent one by selling the company?
Exactly. For a massive, big pharma company, Molbrivi is pure accretive profit because the commercial costs are highly synergistic. But for Savara alone, that sales force is a massive, cash-draining cost center.
So if Savara stubbornly stays alone and independent, it will likely be a grueling, grinding, decade-long battle of slowly scaling operations, dealing with massive stock volatility, and enduring constant shareholder dilution.
But if they swallow their pride and get bought out after the FDA data looks good, the current shareholders get a nice cash premium and walk away happy.
So the ultimate hope for the prudent retail investor here is really an exit strategy via corporate acquisition. You are essentially hoping a much bigger fish comes along and swallows the bait before the commercial reality sets in.
Yes, the independent path is just fraught with too much peril. The acquisition path is the true golden ticket for the stock.
This has been an incredible, highly detailed breakdown. I really feel like we've looked deeply under the hood of this speculative engine today. But before we sign off, I want to leave you, the listener, with one final provocative thought to chew on.
Let's hear it.
We talked earlier about survivorship bias. When we as investors look back at the highly successful biotechs, the ones that actually made it to the mountaintop, the Vertex Pharmaceuticals and the Regenerons of the world, we look at their charts and we say, see, the biotech model works.
Right.
But we conveniently forget the massive graveyard. We completely forget the hundreds of well-funded companies that had highly promising phase 3 data, successfully navigated the FDA, actually got their drug approved, and then completely failed the commercial launch and went bankrupt anyway.
That happens all the time.
So if you are looking at Savara today, you have to ask yourself, are you betting on the underlying pulmonary science? Or are you betting on the unproven ability of a clinical research team to suddenly and magically transform into a world-class, ruthless commercial sales organization? Because financially speaking, those are two very, very different bets.
That is a phenomenal question to end on.
Thank you so much for tuning in to this deep dive. Don't forget to check the affiliate link in the description if you want to support the show and get that stock bonus.
We'll see you in the next deep dive.